Hi everyone and welcome back to the channel and to another video. Today we're going to be analysing a very exciting high growth business that stock has lost a large chunk of its market value in the past month. As you can see, the company that we're going to be covering is Pinterest. Pinterest stock has dipped around 35% after it reported its Q1 earnings, and there was some concerns around its active user growth, mainly in the US, and concerns around how quickly the business can continue to grow with the world going back to normality. Now, I actually think the most recent quarter had a lot more positives than negatives, and we will dig into that in a moment. But the point of this video will be to review the company and do our usual DCF analysis on the stock to evaluate if the 30% drop in price has potentially caused the stock to go under its estimated fair value, therefore creating a buying opportunity for potential investors. This is not financial advice, and I only have a limited amount of time to cover the business in some detail. So if you are interested in this company and what I have to say about it, then please do your own research, additional research, and make your own informed decision. So for anyone unfamiliar with Pinterest, they're an image sharing or video sharing social media service that enables the visual discovery of information using images, animated GIFs, and videos through the use of pin boards. The company's platform allows people to find inspiration for their lives, including things like recipes, style and home inspirations, do-it-yourself jobs and creations, among many other things as well. It promotes visual recommendations based on the data that's collected on their personal tastes and interests. The company was founded by Ben Silbermann, who is still currently the CEO, and his partner, Evan Sharp. They are also the majority shareholders of the company too, which is very good to see. The company has at times been criticised for not living up to its initial expectations, both in terms of revenue numbers as of today and the monetization of the platform. But this is now a business that does almost $2 billion in revenues as of the last 12 months, and by analyst estimations is expected to reach $3.5 billion in revenue by the end of 2022 next year. So it's a very big company. But how does Pinterest actually make money from its platform? Well, Pinterest makes money via advertising, but specifically promoted pins. And promoted pins, or posts, we could call them, are ads that look similar to user-generated pins, but are paid for by the sponsor of the post. The majority of the time, they're advertising a product with a link to buy straight from Pinterest, or a link to their own website, which takes a consumer over to their platform. They appear on Pinterest user feeds similarly to how Instagram and Facebook promote posts through utilizing their data to target ads based on the user's interests, searches, and other characteristics. So it's targeted ads in a very effective way. And social media and digital advertising, which is the space they're in, are two fast-growing areas in the global economy. So it should be no surprise to you all that Pinterest is currently growing revenues at a very fast pace. The last two quarters have seen 76 and 78% year-over-year growth, with a visible sight to profitability as well. So it's been a very good few quarters, at least in my opinion, for Pinterest. However, as I mentioned, the concern for some investors has been around the stagnation in the monthly active users quarter over quarter, more specifically in the US, which is where 80% of Pinterest revenue is generated, even though it only makes up 20% of their actual user base. And this is something that Pinterest will have to work on if they're going to continue growing the business in the way in which investors want them to, and something to actually make up for their valuation at the moment. As you can see, their average revenue per user is around $3.99 in the US versus just 26 cents for international users. I'd like to see this broken down in a bit more detail, but essentially it tells us that one US user is worth 15 international users to this company in terms of the value which it creates. Now, that's something they will definitely need to change in the future. And if they can change that, of course, it's obvious it will lead to a lot more revenue and a lot more profit for the company, because at the moment, they're probably not making any money off of these international users. But one thing I will say, the slow in monthly active users, or active users quarter over quarter, shouldn't be taken as badly as it is. Now, I know it is one of the key metrics for this company. It's a social media platform. Users drive revenue at the end of the day. But we've seen the same thing happen with Facebook and other social media and digital advertising platforms before, and they still manage to grow revenue at a very fast pace just by monetizing more effectively. You see, the real key here for these businesses is developing a huge network of loyal users first, get them loving the platform, and then install various means of generating revenue later on once everyone's got pretty much addicted to the platform. And Pinterest network seems dwarfed by the likes of Facebook, YouTube, or Instagram, but they fare well against the likes of Twitter and Snapchat, who are massive platforms within their own right. So Pinterest is no longer a small social media platform. It is one of the bigger ones. And whilst 442 million active users is a big number, I'd argue they can grow this, number steadily over time from here. But more importantly, like we touched on, they are really early in the stages of monetization. I feel they can go down a few more avenues to start raising that average revenue per user, which is really the key metric for this company and its growth. Firstly, you'd hope they can start to attract more international advertisers, given the amount of users they have now in the international space. They could do this by partnering with some international brands like they have done here in the US with Lowe's and Wayfair. That's what's sort of driving the average revenue per user up in the US. They've got all of these advertisers in the US, not really got many internationally. But secondly, the company has spoken about its interest to build on its e-commerce efforts and its e-commerce platform. This would make a lot of sense and align with the general use of the platform, because unlike Facebook, Instagram, or Snapchat, what makes Pinterest unique is people go there to source ideas for purchases or creations, meaning the platform attracts more meaningful buyers of product than the rest, which are more for social interaction than anything, I think we could argue. Okay, so now we'll talk about the financials, do the DCF analysis on the company, and also talk through some of the most recent quarter's results and what were the most important indicators I think they gave in those earnings reports. So we'll try and talk through that all in one. We'll look at the results for the company quickly now. You can see they've scaled up from near 500 million in 2017 to around 2 billion as of the latest trailing 12 months. And this is only up to Q1 2021 as well. So you'd expect that they'll reach somewhere between 2.5 to 3 million for the full year in 2021, depending on how quickly they grow in the remaining quarters. On an EBITDA basis, they are now profitable, nearly a 5.5% margin, not massive compared to how quickly their gross margin is scaling up. 75% gross margin at maturity, that usually suggests somewhere between 20 to 30% bottom line margins, but we'll get into that in a moment. Free cash flow as well, free cash flow positive, up at 12% as a free cash flow margin as of the last trailing 12 months, which is really good to see. Quite a lot higher than EBITDA though, so I'm guessing it's more of a one-off than something we could probably take as happening in the next years ahead. So I'm just going to count that as a one-off for now. Their balance sheet actually is quite interesting. They do have a very clean looking balance sheet. They've got 914 million in cash, but that doesn't tell the whole story because they have quite a lot of short-term investments as well and marketable securities. So if we're looking at what their real cash and cash equivalents is, not excess cash, but it's around 1.76 billion as of today, maybe a little bit higher on the trailing 12 months. But so it's a very healthy number. They don't have much debt. They don't have hardly any assets apart from cash because of the type of business that it is. It's a very asset-light business. Doesn't need much startup capital or working capital whatsoever. And on the topic of profitability and EBITDA, one thing I do want to look at is their adjusted EBITDA numbers, because we don't have a real good idea of how profitable this company can be yet. Obviously, we know it has very good gross margins. We know it's a very asset-light business, so that usually suggests that it could be a high margin business. Now, you have to be careful with adjusted EBITDA numbers a lot of the time, especially with early companies, ones that are unprofitable. They try and tell you, if you take out this cost, take out that cost, some of these non-recurring items, look how profitable we can be. But in the case of Pinterest, their adjusted EBITDA numbers are very impressive. Q4 2020, they managed 42% adjusted EBITDA. Q3 was 21%, and then most recently, it was 17%. And this is going from quarters before that, them being unprofitable even on an adjusted EBITDA basis. So there definitely is progress there. And when we look at the reconciliation for adjusted EBITDA and GAAP EBITDA, we start to see the main cost that they are incurring into this regular EBITDA that is driving it down from the adjusted number. And that is share-based compensation. They have a huge amount of share-based compensation and non-cash charitable contributions that are driving that EBITDA number down on a GAAP basis. So share-based compensation obviously is a valid cost. They have to account for it, but it's something that as a percentage of revenue, as a percentage of earnings, should start to taper off as the business gets larger and it gets more mature. Obviously, it's in its early stages, IPO'd only around 2 years ago, so there are going to be some share-based compensation expenses that they're going to incur in the next years ahead. So just wanted to point that out, is that should give us a good idea as to how profitable this company can be in the future, especially if we look at that Q4 2020 number. 42% adjusted EBITDA, that's a very, very big number. And even the 20s that it's sitting at the moment, that's a good number to think about for its future profitability. Now, looking at the forecast, I will point out, and you'll probably see here, this has got bullish tagged on it. So I am going to show two different forecasts just to look at the risk reward with this company, because you can see it's not trading at a low valuation, 20 times current sales, and then an EV to EBIT of around 365 times. So it's definitely not cheap. And in the market that we're in at the moment, where valuations are constantly resetting, there's scares about interest rates as well, where some of these companies that are at really high multiples are getting punished. So we want to be careful. We want to look at the risk reward, which is what we're going to do. But for this bullish scenario, I've got them growing up to around 7.5 billion in revenue by 2025. That's a 35% compound annual growth rate. I don't know exactly where analysts sit for the 5-year period, but I do know that they expect somewhere in the region of 45% over the next 2 years, and that they'll get to 3.5 billion of revenue by 2022. So I'm just taking a number on from that. I do think they can get to 7.5 billion of revenue. It's not going to be too hard for them to do that. They need to obviously expand their user base from where they are now, but the main thing is monetizing that international user base and the US user base as well, yes, but lifting that average revenue per user on the international side, because that is where most of their users are, but they've got such a low RPU that at the moment, those regions are losing the company money. So I've done that, and then I've also got margins scaling up to around 30%, all right, in this bullish scenario, because I think with the 75% gross margins they may continue to slide upwards with scale. Obviously, we've seen them go from 62 to 75 in the case of 3 to 4 years. 75% gross margins usually does indicate somewhere between 25 or 20 to 30%. So let's say they can get those 30% EBITDA margins, and what they were showing us on the adjusted EBITDA numbers in the most recent quarters is a good indication of how profitable they can be in the future once those non-recurring items start to level out. Free cash flow, I've just got matching that at the moment. Free cash flow's fared better than earnings in the past, but we're just going to keep it the same as earnings. Obviously, I don't spend hardly anything on CapEx because of the type of business they are, so I expect it to be somewhere in the region of 100% of earnings, maybe a little bit more or a little bit less. That's not the most important part of this valuation, though. The multiple or terminal value is obviously going to be the most important part, which it always is. I've got here an EBITDA multiple method of terminal value. Now, I've gone with 30 times EBITDA, which could be seen as high if we're forecasting out 5 years into the future. But obviously on the social media and digital advertising side of things, it's a industry at the moment that has relatively high multiples because of the growth, future growth that's projected with the industry. So I'm sticking it down to 30. That is currently, a lot less, or that premium, that multiple you're paying for the company is a lot less than you're looking at the moment. So we're saying that the market is going to start reducing the premium that they want to pay for this company. That gets them to around 67 billion in enterprise value for the company. If we add back in some of the cash and less the debt, that gets us to a market cap of around 68.8 billion. And a share price or target price in 2025 of $107 per share. Not bad, but at a discount rate of 15%, unfortunately, even on this bullish scenario, it still shows the company as being 10% overvalued. Now, we are talking about fairly fine margins here when we're looking at 10%. If you manipulate some of the growth rates, to push them up a little bit further, maybe get them to 10 billion in revenue, and then the profit numbers more or less stay the same, then you're probably looking at a fairly valued company. But again, I don't want to be pushing the growth numbers too high here. This is part of the reason why the stock sold off in the first place. The relative unknown aspect of how quickly this company will grow in normality, so out of the COVID period. I think they'll still grow. I don't know if you'll see 50% CAGR over the next 3 years like we have seen in the past. So I think 35 is more than fair on this bullish case. Now, the bearish case scenario tells a much different story and actually doesn't look very pretty whatsoever. I've got growth averaging around 30% for the period. Profits only make it to around 25% instead of 30%. And then we've still got 30 times multiple. All right, so we're still being relatively bullish on the multiple, 30 times. Unfortunately, with my discount rate of 15%, that means that the stock is around 30% overvalued. All right, and the fair price to pay would be $39.50 or 25 billion. So unfortunately, that's a lot less than the current market cap of the company, which is around 38 billion. Now, this is the bearish scenario, but it's one of those where you look at it and you think, well, even if they grew at 30% for the next 5 years, management would probably pat themselves on the back. You know, they made 6 billion in revenues. That's a 3x in revenues in just 4 to 5 years. So it's nothing to turn your nose up at. And that's where the problem lies for me. Is the risk reward really isn't there for this one at the moment because of the valuation. It's a very good platform. I've heard really good things about it, and the idea is great. I think if they can expand, on their platform in terms of making it a bigger e-commerce play or something like that, then these numbers could look a lot different. But for now, taking the company at face value, the risk reward isn't really there. Now, in an IRR calculation, that bull case that I've shown you indicates an IRR of anywhere from 13 to 40%. So not a terrible return, but again, we were being fairly bullish on that. And then the bear case, so it doesn't look very pretty whatsoever, indicates an IRR of just 5% over a 5-year period. If you were to hold the company and it was pegged with a 30 times multiple in 2025 based off the forecast that I've given. So like I say, risk reward really isn't there for me on this one, but it was a company that was requested quite a lot on the platform here on YouTube and also on the Discord and Patreon. So I thought best to cover it. We also had a big drop, but unfortunately it looks like that drop was more than justified. Very recently, that 30% drop was justified, and it probably was something to do with a valuation reset. Now, like I said, this is just my opinion. These are just my forecasts, so don't take them as concrete evidence that the stock is overvalued or anything like that. If you already own Pinterest and you think it's fairly valued, of course that is your opinion, and I could well be wrong. This here, like I said, indicates a 12 to 13% return. So actually, on a lot of people's required rate of return or discount rate, it could be seen as undervalued. So like I say, it's just my opinion. I will leave this spreadsheet and all of the tabs available for members of the Patreon and the Discord to have a play around with yourself. You can put in whatever growth numbers you want, whatever margin numbers you think they can achieve. Maybe give yourself a different multiple as well, and you can see how fairly valued you think the company is at the moment. So that will be available on the Patreon if you want to go and support the channel and get benefits as well. Go and check that out. I'll be doing some more videos this week and next week on some other companies, so let me know in the comments below which companies you would like to see. But until next time, good luck with all of your investments. I will see you in the next video.